So if you go to a financial website right now, let's say you're looking up a stock ticker on MarketBeat, you'll probably hit a screen that says, verifying you are not a bot.
Right, the standard Cloudflare verification.
Exactly. And it takes maybe 3 seconds. You don't even think about it.
Yeah.
But making those 3 seconds happen actually requires this, like, massive, invisible, multi-billion-dollar physical empire.
It really is incredible. We get so used to our screens that it is incredibly easy to forget that the digital world has a physical footprint. I mean, every single byte of data is moving through a tangible piece of hardware somewhere on Earth.
And that is exactly our mission for this deep dive. We are taking a stack of sources that, well, on the surface, they seem completely disconnected.
Right, because we have the web traffic logs.
Yeah, we've got a pair of automated Cloudflare security verification logs from that financial site, MarketBeat. And sitting right next to them, we have these massive, highly detailed Q1 2026 earnings reports and supplemental financial data from Brookfield Infrastructure Partners.
Or BIP. Which is such a fascinating juxtaposition because Brookfield is essentially one of the mega landlords of the global economy.
Right.
By dissecting their financial plumbing, we get a highly accurate roadmap of exactly where the world's infrastructure is heading.
So let's start with the sheer scale of this blueprint, because the numbers in this Q1 report are just staggering.
They really are.
In the first quarter of 2026 alone, BIP generated $709 million in what they call funds from operations, or FFO. That comes out to 90 cents per unit, which is a 10% increase year over year.
And that FFO metric, that's the golden number in the infrastructure world.
Why is that better than just looking at profit?
Well, if you just look at standard net income, the waters get very muddy very quickly. You have massive depreciation charges because, these are physical assets slowly aging.
Like pipelines rusting or concrete cracking?
Exactly. Plus, there are various non-cash accounting items. So funds from operations strips all that accounting noise away. It shows you the actual tangible cash the business is generating from its day-to-day operations.
And that cash is definitely flowing. I mean, they reported an 8% organic growth rate, which sits very safely at the high end of their 6 to 9% target range.
It's a very comfortable beat.
Yeah, and the sources break down exactly how they hit that 8%. A huge chunk of it, about 3 to 4%, comes purely from inflation indexation.
Meaning as global inflation rises, their contracts automatically raise prices.
Right, it's built right in. Add in some volume upside and the cash flows they're reinvesting, and you basically get a fortress of a balance sheet. But the kicker for me was that 85% of that FFO is supported by regulated or long-term contracted revenues.
It is designed to be the ultimate sleep well at night business model. I mean, they are collecting tolls on the major arteries of global commerce.
Right.
They honestly don't care what kind of car is driving on the toll road or what specific data is moving through the fiber optic cable. As long as the volume is there and the contract is locked, they get paid.
Okay, let's unpack this, because I read through the actual income statement in the supplemental data, and this fortress has a pretty weird-looking crack in it.
The net loss.
Yeah.
Right.
If they are generating all this cash and their contracts automatically adjust for inflation, like you said, why does the report show a $61 million net loss for the quarter?
Right.
Because last year they had a $125 million profit. So dropping to a $61 million loss looks like a massive disaster on paper.
It definitely looks alarming at first glance, but this is a classic scenario where strict accounting rules temporarily mask the underlying economic reality.
Okay.
That $61 million loss is almost entirely driven by what the report labels as unrealized mark-to-market hedge losses within their midstream segment.
Okay, but let me push back on that, though.
Yeah.
Midstream means they're dealing with physical commodities, right? Like pipelines, natural gas processing, storage facilities. And the sources mentioned global commodity prices spiked during this quarter. So if I own a natural gas pipeline and the price of gas goes up, shouldn't I be making more money? Walk me through how locking in a price through a hedge actually creates a $61 million loss.
It essentially comes down to opportunity cost and how accountants are forced to record it. So think about why a company hedges in the first place.
To be safe.
Right. Brookfield wants predictable cash flow. So they enter into a financial contract, a hedge, to lock in the price of the natural gas they process at, let's just say, $3. They are guaranteed to get $3 no matter what happens in the market.
Okay, that makes sense.
But then, a geopolitical event happens and the open market price of natural gas suddenly spikes to $5.
Okay, so they are still getting their saved $3, but they are missing out on the extra $2 they could have made if they just hadn't hedged at all.
Exactly. And current accounting rules require them to mark to market. They have to look at the current market price of $5, compare it to their hedged price of $3, and record that $2 difference as an unrealized loss on their income statement today, even though the contract hasn't even finished yet.
Oh, I see. It's a lot like checking the Zestimate on your house.
How do you mean?
Let's say you agree to sell your house to a friend next year for $500,000 just to keep things simple and safe. But suddenly, like a massive tech company announces they are building a headquarters right next door, and houses on your street are suddenly selling for $700,000.
Right.
You haven't actually written a check for $200,000. You didn't lose money out of your bank account. You just have a paper loss representing the upside you missed out on because you locked your price in early.
That is a perfect way to visualize it. It is entirely an unrealized paper loss. And the crucial thing the sources point out is that as those hedges naturally settle and expire over the coming months, Brookfield will start capturing the actual financial benefit of those higher commodity prices on their unhedged volumes.
So it fixes itself.
Exactly. The economic reality is that higher commodity prices are good for them. The accounting just creates a temporary lag.
Which really brings us back to why you focus on the FFO, the actual cash in the bank rather than the net income. Because their payout ratio, which is the amount of cash they are handing back to investors, is sitting at a very healthy 65%.
And that 65% falls right into the sweet spot of their long-term target, which is 60 to 70%.
Nice.
It gives them enough yield to keep investors happy while retaining enough cash to comfortably manage the business.
They even raised their distribution by 6% to 45.5 cents per unit this quarter. But before we get to how they actually spend their money, there was this really interesting piece of financial engineering in the report that I want to touch on, because it shows how infrastructure is built on Wall Street just as much as it is in a construction zone.
The structural combination.
Yeah. The board is currently exploring combining their limited partnership structure, which trades under the ticker BIP, with their corporate structure, which is BIPC, into a single tax-free corporate security.
This is a highly sophisticated move because currently an investor has a choice. They can buy the partnership units, BIP, which sometimes carry complicated tax reporting requirements, things like K-1s in the U.S.
Nobody likes K-1s.
Nobody. Or they can buy the corporate shares, BIPC, which were created to be economically identical but offer standard tax reporting.
But having two different tickers kind of splits the attention of the market.
Exactly.
By combining them into one massive corporate entity, they are looking to massively increase the trading liquidity of the stock. And more importantly, the sources note this could lead to inclusion in major broad market stock indices.
Which is the holy grail.
It is.
Yeah.
If you get added to a major index, every passive index fund in the world suddenly has to blindly buy your stock. It's just a brilliant way to lower their cost of capital without pouring a single ounce of concrete.
It lowers the cost of capital, which is vital, but it brings up the core operational question. If they are paying out 65% of their cash flow to investors every single quarter, how do they actually afford to buy multi-billion-dollar rail networks and build massive data centers?
Yeah.
The retained cash simply isn't enough to fund that level of hypergrowth.
Yeah, that is exactly where the strategy of capital recycling comes in. And looking at the mechanics of this, it is basically house flipping, just on a macroeconomic scale.
Underlying philosophy is very similar, yes.
Here's where it gets really interesting. We need to be clear about how they do it, because they aren't just buying a fixer-upper pipeline and slapping some fresh paint on the valves.
No, absolutely not.
The mechanism of the flip is where the genius lies. They buy an asset that is maybe underperforming or carries a lot of risk. They step in, optimize the physical operations to lower costs, and crucially, they negotiate new 20-year contracts with major suppliers to completely stabilize the revenue.
They de-risk it.
They de-risk the asset, exactly. And once it's boring, predictable, and safe, they sell it at a massive premium to a pension fund or a sovereign wealth fund that just wants a slow, steady yield.
You've completely nailed the mechanism. The value creation is in the de-risking, and the pace at which they are executing this is intense. Just in this first quarter of 2026, BIP secured roughly $1 billion in capital recycling proceeds.
$1 billion in 3 months? I mean, what exactly are they unloading to generate that kind of cash?
The sources list a highly strategic mix of asset sales. They sold a 12% stake in a North American gas storage operation. They closed the first phase of selling down a portfolio of stabilized U.S. hyperscale data centers.
Notice the word stabilize there. They built them, leased them, de-risked them, and are now cashing out.
Precisely. They also sold the largest of 4 concessions within their Brazilian electricity transmission business. And just after the quarter closed, they inked a deal to sell a Scandinavian bulk liquid storage business.
The geographic and sector diversity there is just wild. And this isn't a new pivot for them either. The historical context in the report shows that over the last 5 years, this capital recycling strategy has generated about $7.4 billion across 28 different transactions.
It's an engine.
A massive engine. They achieved a combined gain over book value of around 70%, and they highlight an average internal rate of return, or IRR, of 23%.
And that IRR figure is the metric that institutional investors look at closest.
Let's break that down, actually, because IRR can sound like impenetrable finance jargon. How does a 23% IRR differ from me just saying, I made a standard 23% return on my stock portfolio?
It is all about the time value of money. So a simple return on investment just looks at the money you put in versus the money you got out.
Right.
If you double your money, that's a 100% return, whether it took you 1 year or 50 years. Internal rate of return, however, factors in the timeline. A 23% IRR means that for every single year Brookfield held that asset, the capital they invested was compounding at an annualized rate of 23%.
Wow.
Achieving a 23% compounding rate over a multi-year holding period on physical, multi-billion-dollar concrete and steel assets is exceptionally difficult.
And it explains why this strategy is so crucial right now. I mean, we are operating in an era of elevated interest rates. Going to a bank to borrow $1 billion to build a data center is incredibly expensive right now.
Prohibitively expensive for some.
Right. But if you have $7.4 billion rolling in from selling your stabilized assets at a 70% premium, you don't need the bank. You are self-funding. It is a massive competitive moat.
Self-funding allows them to act aggressively when competitors are sidelined by high borrowing costs, which brings us to the most revealing part of these earnings, which is where they are deploying that recycled capital.
Right, because watching where a global mega landlord moves its money tells you exactly how the global economy is shifting.
Yeah.
We can see this play out by looking at their 4 main operating pillars. And instead of just reading them off, let's contrast the old world with the new world.
Yeah.
So we'll start with the foundation, which is utilities and transport.
So utilities generated $201 million in FFO for the quarter. It is the very definition of slow and steady, showing a 5% growth rate.
Nothing flashy.
Right, nothing flashy. That was driven largely by a 9% increase in UK utility connections and the integration of a newly acquired South Korean industrial gas business.
It's the bedrock.
Okay.
Then you have transport, which brought in $283 million in FFO. Now, this is actually down slightly year over year, but only because they strategically sold off some Australian ports and intermodal logistics assets.
Right.
They are still heavily invested in physical movement, though. The report highlights they just bought a North American railcar leasing platform with GanAx for $300 million, and they issued an inaugural $1 billion investment-grade bond specifically for it.
So the physical movement of goods and basic utility connections are stable. They're generating reliable cash. But the growth trajectory starts to steepen when we look at the third pillar, which is midstream.
Okay.
This segment generated $190 million in FFO, which is a very strong 12% jump from the prior year.
And the physical reality behind that 12% jump is fascinating to me. The report notes their U.S. refined products pipeline system hit a record 98% utilization rate.
Which is an extraordinary metric for a physical pipeline system.
Just think about what 98% utilization actually means. That pipe is not sitting idle. It is essentially screaming, moving pressurized fluid 24 hours a day, 7 days a week, with almost zero downtime.
Pushed to the absolute limit.
Yeah, the customer demand to move those refined products is at absolute maximum capacity. They also reached a final investment decision to build a Canadian carbon capture facility, backed by a long-term take-or-pay contract.
But as impressive as a maxed-out pipeline is, it completely pales in comparison to the structural shift we see in their fourth pillar, data.
This is the pivot. The data segment generated $149 million in FFO. That is a staggering 46% jump from the prior year.
46%?
Yeah. So what does this all mean? You put these 4 pillars side by side, and the narrative is undeniable. We're watching the infrastructure of the world transition from the physical movement of shipping containers and natural gas to the digital movement of information.
Absolutely. The capital deployment in the beta segment proves they are anticipating a massive bottleneck in global computing.
How so?
The report details that over the last 12 months, BIP commissioned over 200 megawatts of new data center capacity globally. They acquired a massive U.S. bulk fiber network just to connect those centers.
They also secured a 20-year anchor tenancy for their French telecom towers with a leading mobile network operator. And the sources specifically mentioned that this single contract represents $35 million of run rate EBIT.
And that is a key valuation metric for them.
Let's translate that for a second.
Yep.
EBITDA stands for earnings before interest, taxes, depreciation, and amortization.
Right.
It is essentially a measure of the raw operating profitability of the cell towers before the accountants get involved.
Yeah.
And run rate means they're taking a snapshot of the current monthly earnings and projecting it forward for the full year.
Right. Assuming nothing changes.
So they have secured a guaranteed $35 million a year in raw operating profit from this one tenant locked in for 2 straight decades. That is exactly how you stabilize an asset before you eventually flip it.
Completely. And perhaps their most ambitious digital project is the $3.9 billion partnership with Intel to build 2 U.S. semiconductor foundries.
Wow.
They report that the construction is tracking on time. This is full vertical integration. They are financing the factories that manufacture the microchips, which will be installed in the hyperscale data centers they build to process the data that travels over the bulk fiber optic networks they own, which is transmitted to the cell towers they lease.
It's an entire digital ecosystem under one umbrella. But, building out this digital monopoly has slammed into a very physical, real-world wall.
It has.
You can lay all the fiber optic cable you want, and you can build the most advanced AI data centers on Earth, but they are completely useless without the single most important commodity in the modern world.
Electricity.
Yep.
The sheer power required to run the modern digital economy is astronomical, and it's growing exponentially with the rise of generative AI and hyperscale cloud computing. The physical, public electrical grid simply cannot handle the load.
And this bottleneck directly leads to Brookfield's newest and honestly most fascinating strategic initiatives in the entire report. They are deploying massive amounts of capital with high-quality counterparties to solve this specific problem. First, they launched a new $1.5 billion equipment leasing platform with a major OEM. Brookfield's share of that is $375 million.
The use of the acronym OEM there, original equipment manufacturer, is highly significant.
Right, because we aren't talking about leasing out laptops or office chairs. When we are talking about data centers, OEM equipment means the massive, specialized industrial machinery required to keep these facilities from basically melting down.
Exactly.
We are talking about giant industrial cooling towers, high-voltage transformers, and commercial-grade HVAC systems. Brookfield is financing the literal life support systems for the cloud.
And that leads to their solution for the power generation itself. During the quarter, they advanced a massive partnership with Bloom Energy, committing an additional $430 million.
It's huge.
That brings the total framework to approximately $1.6 billion. The stated goal of this investment is to install up to 1 gigawatt of behind-the-meter power generation.
Wait, what exactly is behind-the-meter power generation, and why are global tech giants so desperate for it that BIP is spending over $1 billion on it?
So normally a building plugs into the city's power grid. The public utility measures what you use with a meter, and you pay them. The public grid is in front of the meter.
Okay, that's what we all do.
Generating power behind the meter means you aren't pulling from the city at all. You are building your own dedicated power plant. In this case, Bloom Energy's solid oxide fuel cells. You build it right there on the property, on your side of the electrical meter. You are completely bypassing the public utility.
That is incredible. And the earnings report explicitly cites the reason why tech giants are demanding this, they say. Strong customer demand for speed to market.
Because of the AI arms race.
Exactly.
If a major cloud provider or an AI developer wants to build a new massive facility, they go to the local public utility and ask for 100 megawatts of power. The utility looks at their aging infrastructure and says, sure, we can provide that. We just need to upgrade 3 substations and run 20 miles of new high-voltage transmission lines. It will take us 7 to 10 years to get the environmental permits and finish construction.
10 years. But the tech company needs that data center online in 18 months, or they lose the AI race to their competitors. They literally cannot wait for the public sector to catch up.
So Brookfield steps in and says, don't worry about the public grid. We will finance and build a private, behind-the-meter power plant to run your private data center.
Wow.
It is a profound shift. The digital economy is actively outgrowing the physical constraints of our legacy systems, and private capital is stepping in to bridge the gap.
Which brings us full circle to how we started this journey today. We looked at a simple Cloudflare screen, a tiny automated script that runs for 3 seconds to make sure you're a human before letting you look at a stock chart.
Right.
But to make that one tiny interaction possible, we had to trace the plumbing all the way down to the bedrock.
It requires an immensely complex, interconnected system. That bot check runs on a server sitting in a hyperscale data center, kept from overheating by leased OEM cooling systems, powered by a private gigawatt fuel cell network, funded by the massive profits of flipping an optimized natural gas pipeline, and engineered by Wall Street liquidity moves to keep the capital flowing.
Yeah, those Wall Street moves like the board exploring that single tax-free corporate security, combining BIP and BIPC.
Exactly. Infrastructure engineering on the market itself.
It is entirely invisible to us as we scroll on our phones, but it is the most lucrative machinery on the planet.
And looking at that machinery leaves us with a critical structural question about the future of our economy.
What's that?
Well, as these massive tech giants increasingly rely on companies like Brookfield to build private, behind-the-meter power grids and dedicated, closed-loop fiber networks, are we moving toward a reality where the digital economy operates as its own sovereign utility state, totally detached from the public grid?
A parallel infrastructure built exclusively for the giants.
Exactly. And if that is where the capital is flowing, what happens to the rest of the businesses and the rest of us who are left relying on the aging, slower public infrastructure that got left behind?
Yeah.
Will that little bot protection screen be the only bridge left between the public roads we drive on and the private gigawatt-powered empires operating behind the scenes?
It is a structural shift that will completely redefine how cities and economies operate for the next century. And that is exactly the kind of question we want you to take away from this. The world around you is constantly being built, optimized, and flipped. So the next time you hit a screen that says verifying you are not a bot, just remember the invisible billions of dollars working furiously behind the scenes to make it happen. Thanks for joining us on this deep dive. Keep questioning the invisible systems around you.